But again, that's the potential. And I think that's what excites me about it. You know, in our operating company, we have a weighting of 20% into crypto across all the different, you know, owning shareholders we have, like WonderFi, like Mutable Holdings, like FTX, like Circle, and then the tokens and the coins themselves, like USDC and Bitcoin, Ethereum, Solana, HBAR, Paula, and Helium. I can go down the list. I own them all, and that's because, particularly if that's the consensus, that's extremely bullish for markets. Obviously, have to cover. If you look at hedge funds as an index, they're wrong 50% of the time, and you'd expect that. Different strategies, obviously, but the added bonus about hedge funds and why they can add a lot of volatility, and sometimes to the upside, is many of them use 3 to 7 times leverage. So when they're wrong, they're really wrong. And obviously, that's even been exacerbated in the crypto market, where we've seen lots of leverage blow up all kinds of different business models, which I consider very healthy. So the reason that it's been difficult to really call the bottom in the market or time the market, if you weren't participating in it during the 5 weeks of trading in July and August, you've missed all the gains this year. And they were unanticipated gains when the market decided that the economy was much stronger than people gave it credit for, and that consumers, still awash in $6 trillion worth of free printed cash, are still spending. So where we go next is a huge debate. It's whether it's 50 basis points or 75, it's one of the above. And then probably one more hike after that. And then we'll have to see what the Fed does. But all of this is baked into the market. And earnings in the last quarter have been much better than anticipated. So everybody's been confounded by the economy, by the market, and even crypto. Excitement about it. And one of the reasons I'm long, certainly WonderFi stock and 32 different crypto projects, is that I believe over the next 2 to 3 years, we will get regulation. And then finally, we can get institutional participation. People forget that 70% of the world's wealth is tied up in pension and sovereign wealth funds. And so if they're not allowed to buy the asset class, there's no underlying bid. And that's one of the reasons we can't get crypto past $24,000. It's really hard because there's not really a large constituency that's permitted to buy it yet, particularly Bitcoin and even Ethereum. And even USDC, probably, the 3 most popular right now. And so if we do get regulation first, it'll probably happen in stable coins, because that's been very volatile lately, and there is policy on the table in the Hill, bipartisan policy that's being contemplated as early as next September, which is not far away, just weeks to be looked at. And if not, it'll be after the midterms, but that's coming first. And then, of course, it'll be on to Bitcoin and others, whether they're allowed in an ETF. But that's the upside. That's why you participate. But to say that, it's a real asset class, it's not there yet. It's still nascent. It's tiny, but it doesn't mean you shouldn't invest. You should be ahead of when it's finally made a real asset class, because its price will materially appreciate. That's my investment thesis. From the context of an investor, not any one specific blow up, but over the last 90 days, we've had catastrophic failure in all kinds of different business models, from stablecoin to platforms that do lending. I mean, this is actually a good thing from this perspective. I mean, what's occurring here is the experimental business models, or what I would call, without showing any disrespect when I say this, but just idiot management teams that have never had any experience with leverage, because leverage has destroyed platforms long before crypto, whether it was stocks or bonds or real estate. If you don't understand what you're doing with leverage, you get wiped out, and you should get wiped out. And it's a very important learning experience for the market, and it scrapes the patina of idiot management out of the ecosystem, and it leaves the remaining companies much stronger. And that's the important part. When a Luna gets wiped out, an algorithmic stablecoin, it's a good thing. Now, yes, you have to sacrifice the company, and you have to sacrifice some shareholders, but it's for the greater good of this nascent industry. And so everybody learns the hard way when you deal with idiot management. And idiot management, it's like a Darwinian force. The market scrapes them out of the system. They have a very hard time coming back, and nobody will capitalize them. And that's great. And I think we're going through we're probably in the 3rd inning of that. And the remaining companies are far better off. There's much more to acquire. There's assets out there that are very inexpensive. There's a consolidation going on, and the majority of survivors are much better at managing their situation. So, agnostic to the next thing that blows up, and I'm sure there'll be more, my attitude is, who cares? This is great news. I think it's important. You made a good observation that in the case of Luna, which got a lot of press globally, it was important for that to blow up because it actually got some focus within Washington, D.C. on a bipartisan basis on legislation just for stablecoins as payment systems. And so the idea that we can get one bill to actually regulate the entire crypto ecosphere is not realistic, and that's not going to happen. You think about the broad spectrum from NFTs to tokens to various projects, and I always get people to remember when I can is to say to them, Bitcoin is not a coin, it's software. Ethereum software, Solana software, Polygon software. These are software projects. Will eventually prove out their merit or they won't based on the economics of revenue at some point and all the applications that sit on top of these. So they'll either win because they're good technology or they won't. And so if you're a venture investor, as I am, you want to take a lot of positions because you don't have certainty in what outcomes are going to occur. You need diversity. But in the case of stablecoin, the opportunity, which is so interesting, is that a stablecoin backed by the US dollar and treasury bills, for example, no different than a money market account, would overnight, if it was passed and regulated, let's just take USDC by Circle, for example, and it was actually regulated as a payment system, that would create a standard of payment backed by the US dollar globally. And what politician, regardless of what state they're in, doesn't want that? It secures a place for the American dollar beyond just commodities of oil and iron and other payment systems that are built around commodities that are always backed by the US dollar. But that legislation is very simple. It's 5 pages in some of the bills by Haggerty and Toomey that simply says, look, we audit it every 30 days. We make sure that nothing that's supporting the token is a duration longer than 12 months. And we have total transparency in these audits. Now, not every stablecoin is going to survive the transparent audit, but that's okay. There's enough of them that will, or be started that will. And then we let companies compete, just like there's a money market fund at Fidelity and there's one at Schwab and other firms. That's great, but they're basically all the same because they're FDIC insured and they're regulated. Same thing with stablecoins. So I think that may come first. And what really was the stimulus for that, the impetus, was the Luna explosion, which was very diversified. So, it wasn't just shareholders or token holders in the United States. That blew up all around the world in a spectacular supernova. And now it's obviously disfavors algorithmic-based or stable coins. They will not be popular because people have been burned. And that, too, is a good thing. So you have to applaud the sacrifice of the Luna token holders and how their DNA and their ashes have probably created something of greater value for the next version of regulated stablecoins. And again, we applaud them, we thank them, and they too will not invest in stupid managers. And all of this is great stuff. It's all good. First of all, the merge has been forecasted to occur for 4 years in a row now. So for all the excitement, I'll believe it when I see it. There's a lot of people that are dissuaded from doing this in the Ethereum mining business, so they're not that excited about it. I think there'll always be, opportunistic token creation and trying to define it, whether you're playing a game or whether you're using it to buy something in the metaverse. There's so many different use cases being tabled, but in the end, when you look at most markets, what you find is it's the adoption of standardization that creates value. So if all of a sudden there's 10 stable coins that come to market for payment systems, my prediction would be that there'll only be 3 survivors 10 years later. And they'll be behemoths, they'll be very large, and they may have slightly different attributes. But, there's already 64 billion in Tether and 54 billion in USDC. They're likely to survive, assuming they can survive audit, and then maybe a few others. And always the rumor of the feds themselves creating their own digital dollar. I'm very skeptical of that. The last place you want development work done is with the government. They're the worst at it. So I'd let the private sector figure that out and just the government provide regulation. But, everybody's speculating on this stuff. The one constant that I would remind everybody to think about in why the use case for investing in this sector, and I personally believe over the next decade, crypto will be the 12th sector of the S&P. And the reason I believe that is when I teach graduating cohorts of engineers, I don't care what college you do it at. You can go to MIT, Harvard, you can go to Waterloo in Canada, or Temple, Notre Dame, you name it. A third of the graduating class, the smartest hands above keyboards in the world, because some of these classes are 130 international, particularly MIT. They have no interest in, as engineers, to go back to the other 11 sectors of the economy. Zero interest in working there. They all want to work on the blockchain. So my argument is you can't take that much intellectual capital, the best and the brightest, put them onto this sector by the tens of thousands every week and not expect incredible outcomes. So it's just like at the beginning of the internet, and all of a sudden when people thought, oh, the internet's not going to be anything, look at it today, it's the backbone of every economy. The same thing I think will happen in crypto just by the amount of intellectual talent. So it seems pretty stupid to me to invite international students from geographies that are very advanced in crypto and then kick them out of the country after they're educated. It's very stupid, and that policy should be fixed. Even the brightest, look at it, Sam Bankman-Fried. I mean, a 30-year-old, 22 billionaire. He is an American citizen whose parents are compliance lawyers at Stanford, and even he doesn't operate in the United States because he has no policy and regulation and backbone to work with. So all of that money and that intellectual capital that he is gathering on the Caribbean islands should be stateside, but it's not. So we have to get some policy into this sector, or we'll continue to lose the country's brain trust in this nascent sector. They're not even allowed to contemplate it into the models. I do a lot of business with financial services companies with more traditional products such as ETFs and indexed equities, et cetera. We have this conversation all the time. They're not going to spend an ounce of time worrying about it until they get instruction that they're permitted to index it. And so we're a very long way from that. And so their own clients are calling them saying, look, we'd like to put 3% into Bitcoin, but they have no way of putting that on the balance sheet of the compliant platform for any of these firms. There's no infrastructure to do that. Bitcoin trades 24/7. The majority of their positions finish trading at 4 o'clock. There's a mark to market with the compliance infrastructure to make sure they're not offside on whatever the mandate is. That's been around for decades, but there's no infrastructure for compliant crypto. So we're a long, long way from that happening. And so most of the people that own Bitcoin are high net worth individuals, family offices, hedge funds, and minor institutional clients, very minor. And so that's the opportunity, though. That's the upside. The whole idea is that if you think it's eventually going to get regulated, all of those other players will come in, and then all of a sudden there's going to be 1 to 3% allocation in the typical portfolio, which is no different than a fixed income or bond portfolio or equity portfolio. And that's when this industry will begin to mature. And then also companies will build the financial infrastructure to actually be compliant in crypto with the reporting, whether it be capital gains and losses or some kind of lending program where there's an income to it, or staking. All of that has to get worked out, but just zero compliance platforms. And so it's really hard to do that right now. And so that's why, for all the enthusiasm about Bitcoin, virtually nobody owns it. When you go to these crypto conferences, even the Bitcoin conference, there's two universes. There's 10% of the people, 1 out of 10, are hardcore Kryptonians, if you want to call them that. And they're great. They were the founders of this industry, and they're still very adamant about how it should be, and their opinions matter. But 99%, the other $1 trillion, $5 trillion, $20 trillion worth of interest, are institutions looking from the outside in. And when you go to these conferences today, the majority of people are not investors yet. And so you realize what the great potential is, but also the roadblock of policy keeping us out of it. And I would say now the U.S. is falling behind. I think Canada's more advanced, United Arab Emirates, Switzerland, Australia, New Zealand, England, far more, mindful of the technology here and the use of it in financial services and the potential of it. So I think if we don't get some policy next year after the midterms, we're going to start to lag. There's always that risk, but I don't see that,
Okay.
crypto's not going away. Bitcoin's not going away. Ethereum's not going away. These projects are here to stay. They're well funded. There's a lot of use cases for them. I use USDC now corporately. We have a Circle account. We've gone through compliance and our auditors setting it up. I'm a shareholder of FTX. I'm a shareholder of Circle. I'm also, I should disclose, a paid spokesperson for FTX. I hold 32 different positions on my FTX account because it's the most compliant one I can find in working with my compliance department and my regulator. I do the same with BitBuy, which is, WonderFi. It's one of our divisions, and I've got a full corporate account there too, because these are compliant platforms. So I can be compliant in Canada on BitBuy. I can be compliant in the US on FTX. So you have to find your geography, figure out your compliant platform, and you have to hire a whole bunch of people to manage this stuff for you. So we're so early in all of this, but again, that's the potential, and I think that's what excites me about it. In our operating company, we have a weighting of 20% into crypto across all the different, owning shareholders we have, like WonderFi, like Mutable Holdings, like FTX, like Circle, and then the tokens and the coins themselves, like USDC and Bitcoin, Ethereum, Solana, HBAR, Paula, and Helium. I can go down the list. I own them all. And that's because I don't know with certainty which are going to work and which aren't.